When it comes to senior life insurance policies, one of the most important aspects that often gets overlooked is the role of beneficiaries. Life insurance is designed to provide financial protection and peace of mind, but without carefully selecting and understanding the responsibilities of beneficiaries, the intended purpose of the policy can be weakened. Today, we're going to dive deep into how beneficiaries play a role in senior life insurance policies, what responsibilities they hold, and how to make the best choices when designating them. Let's start with the basics. A beneficiary is the person or entity chosen by the policyholder to receive the death benefit after the insured passes away. This payout can be a lump sum of money or structured payments, depending on how the policy is set up. For seniors, this benefit is usually intended to cover expenses such as funeral costs, medical bills, outstanding debts, or even to leave a legacy for loved ones. Now, there are different types of beneficiaries. The most common is a primary beneficiary, the first person entitled to receive the payout. This could be a spouse, child, or close family member. Then there are contingent beneficiaries, also called secondary beneficiaries. These individuals only receive the benefit if the primary beneficiary has already passed away or cannot accept the payout. For example, a senior might name their spouse as the primary beneficiary and their children as contingent beneficiaries. This ensures the funds still go where they are most needed, no matter the circumstances. It's also important to note that beneficiaries don't always have to be individuals. A beneficiary can also be a trust, a charity, or even an estate. Many seniors who want to leave behind a lasting impact may choose to direct part of their policy toward charitable organizations. Others may set up a trust to ensure their children or grandchildren receive structured financial support over time. Beneficiaries carry significant responsibility, even though they aren't involved in paying premiums or managing the policy while the insured is alive. Their main responsibility begins when the policyholder passes away. At that time, the beneficiary is required to file a claim with the insurance company, provide necessary documents like a death certificate, and then decide how best to use the funds. One key point to understand is that life insurance payouts are generally tax-free to the beneficiary, which makes them a highly effective way of transferring wealth. However, if the policy was left to an estate, or if specific tax laws apply in certain regions, there could be tax implications. This is why seniors and their families should carefully consult with financial advisors or estate planners when naming beneficiaries. Another area to pay attention to is updating beneficiary information. Life changes, such as marriage, divorce, or the passing of a loved one, can make previously chosen beneficiaries outdated. For seniors, this is especially important because circumstances can shift quickly. Imagine leaving a former spouse as the named beneficiary unintentionally, or forgetting to add a new grandchild to the policy. Regularly reviewing and updating this information ensures the benefit goes exactly where it's intended. Sometimes, seniors may worry about how their beneficiaries will use the money. Will they handle it responsibly? Will the funds be used for funeral costs or wasted on non-essential spending? In these situations, policyholders can take steps to guide how the benefit is distributed. Setting up a trust or using structured settlement options can ensure the money is used wisely, rather than all at once. Now, let's talk about multiple beneficiaries. It's not uncommon for seniors to want to leave their insurance payout to more than one person. In these cases, the death benefit can be divided either by percentage or dollar amount. For example, a senior might leave 50% to their spouse, 25% to one child, and 25% to another. Clear instructions are essential here to avoid family conflicts or disputes later on. Speaking of disputes, it's important to note that beneficiaries can sometimes face challenges. Family disagreements, contested wills, or unclear instructions can complicate the payout process. That's why it's so important for seniors to document their wishes clearly, discuss their decisions with family members, and, if possible, work with legal and financial professionals. Finally, let's consider the emotional side of being a beneficiary. Receiving a payout after the loss of a loved one can be overwhelming. While the funds can provide financial relief, beneficiaries are also dealing with grief and difficult emotions. Understanding this balance is important, and seniors can help ease this transition by leaving clear instructions, organizing their policy documents, and making the claims process as smooth as possible. To wrap things up, the role of beneficiaries in senior life insurance policies is much more than just receiving money. Beneficiaries are central to the purpose of the policy itself. By carefully selecting, updating, and communicating with beneficiaries, seniors can ensure their life insurance truly serves its intended purpose, providing financial support, covering expenses, and leaving behind a meaningful legacy. So, if you or a loved one has a senior life insurance policy, take the time today to review the beneficiary designations. Make sure they are current, clear, and in line with your wishes. It's one of the simplest yet most powerful steps you can take to protect your family's future.